Hi, everyone. Thank you for joining WisdomTree's Office Hours Post-Election Update and Fed Watch, where you'll hear from Professor Jeremy Siegel, WisdomTree's Senior Economist, Jeremy Schwartz, our Global Chief Investment Officer, and Kevin Flanagan, our Head of Fixed Income Strategy.
Kevin, Professor, always great to be on with you. Only a few things happening in the.
Yeah, we thought we were going to cancel this because nothing happened this week. But
a few things
yeah, we decided to hold it anyways, right?
Yeah, we love getting your questions, everybody. So we had some pre-submitted. We'll get to those. Professor, we'll turn over to you for.
Yeah. Okay. Let me. The most important is the election, but let me say a few things about the Fed. I mean, the move of the stock market after election was one of the biggest one-day moves we've had. It isn't the biggest, but one of them. The move of the market after and during and after Powell, this meeting of the Fed was one of the smallest we've ever had. So that just kind of tells you a little bit about the importance of the two. I did enjoy his answer, Powell's answer to the question about if Trump asked you to resign, would you? And he said no. There was no hesitation, no statement like, well, I want to work with the new president-elect, all of them, and serve them, and blah blah blah. It was defiant no. Now the truth of the matter, well, let's get back down. I mean, it makes a little drama, but the truth of the matter is he can't remove him. Only a formal impeachment process is. Actually, the truth of the matter is Trump should be licking the boots of Jay Powell. Why? Jay Powell is a major reason why we had so much inflation that elected Donald Trump as one of his major platforms. So he should say thank you for messing up monetary policy so bad and causing so much inflation that it put Biden and Kamala Harris down. The truth of the matter is, he said, he has no reason to get rid of Powell. Powell has the confidence. Powell's caught up. It took a little learning process. He screwed up at the beginning, but he's caught up right now. I was even amazed at his statement that, yeah, we know that rents roll off, and so there's a lag in that. Something that you and I have been talking about for 3 years. Powell's now bringing it up independently. He's caught up as far as that's concerned. The market on Fed funds futures is kind of neutral, almost 50-50 on whether there's going to be a December cut. And as Powell himself said, we have another labor report and 2 inflation reports beforehand. We'll see, basically what's happening. What was interesting to me was there was no dissent. That Michelle Bowman did not dissent after she did before. And I think I think this is what happened. If you take a look at the statement, we're making further progress towards eliminating. They made a lot of progress, but we haven't made further progress. He was asked that question, why was that all left out for the first time in 6 meetings? And he said, it doesn't mean anything. We just don't have to justify every time. We've made a lot of progress, blah, blah, blah. But the truth of the matter is probably a number of the hawks on the committee said, listen, I'll go along with this vote, but we're not making a lot of further progress. We're almost there, and we may get there, but we'll make it unanimous and, to do that. What consequence it has? Not terribly. As I said, it is, if the economy runs strong in the next, December 18th is the meeting, so we don't have a lot of time. We have 6 weeks. It's possible a pause would be there in the market. We already took a look at what is the July Fed funds futures, just to give you an idea. And my eyes are trying to hit that right now, and there it is. It's exactly 390. Now, the current Fed funds rate is 4.83. So, and that's before today's cut. So it's going to go down 25 basis points to 4.57. You have 3.90. We say that that's an underestimate because of biases. I think it should be about 4. So, really, we're talking about, not the market's not predicting that many, not many more cuts. Definitely at most at an every other next year. Okay, enough of the Fed. It seems that the betting markets are saying it's a 96% probability the Republicans take the House. So if the Republicans take the House, therefore sweeping, all that the temporary, the so-called temporary, the Trump tax cuts can all, not the new promised ones, just the extension of the old Trump tax cuts can take place now without renegotiation on December 31st of next year. Now, it is possible that if it's only going to be a 3-4 month margin, that there could be some, extremists on the Republicans say, "Oh, I'm not going to vote for it unless I get this and this and this," and and we get into the same loop as before. I don't think that's going to happen. You don't want to stand, because as I said, if it isn't passed again, it reverts to the Obama rates, and everyone's withholding will go up on January 1st of 2026. So, my feeling is, all right, this guy is going to just causing everyone's taxes to go up. I don't think he or she, whoever it happened to be, was standing in the way, the Republicans. I think that he could get down. The question of the new tax cuts that he's promised. God, bringing back the state and local tax deduction, no tax on Social Security, no tax on tips, no tax on overtime. Should we go, corporate tax rate at 15%, blah, 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 blah. Now, interestingly, I thought the bond market, it was sort of a shot, over his head yesterday saying, just be careful. Now, today, yields are down 10 basis points. Reversing most but not all of yesterday, but some of it. It's going to be the 10-year yield that'll dictate it. If Trump presses all those, and but I think he's going to, if that rate goes up, the rate will help the Republicans that want more fiscal responsibility. They're willing to pass those cuts and extend those 7-year cuts on a reconciliation, because even though the Republicans gain in the Senate, they'll probably have 53, 54, but they're not going to have 60. So they've got to go through reconciliation because there's the filibuster rule is still there, and no one's in the mood in terms of doing that. Of course, the stock market, small stocks really ran over 5% on the Russell 2000 yesterday. I think it backed up a bit today. What do we get? Yeah, only down 39 basis points today. So it really boost, less regulation, favoring, small stocks are more domestic oriented, which are going to tend to be favored by Trump. More friendliness towards mergers. There's a lot of reasons for the small stocks to like the Trump victory and the Republican sweep that we see. That being said, it would be the bond market that would tell Trump and the Republicans they've got to go easy on those tax cuts, which means that if you want the bond market to tell them, that means the 10-year continues to rise. And I have I can't pinpoint exactly when, but into the 4.5% to 5% range seems, very reasonable. Listen, we've talked at every meeting that the normal premium of the 10-year over the Fed funds rate is in expansions between 100 and 150 basis points. If you take that, including the inversion periods, it still averages 90 over the last 70 years. And we're nowhere near that because we're at the Fed funds rate right now of, as I said, 483, and we're at the 10-year that's 433. So, we're 50 points inverted on that. I'm not a big fan of the 2-year, 10-year, because that is implicitly taking into account rate cuts that have not yet materialized. Let's take the current rate. We're minus 50. As I said, the normal is up 150. So now, it's interesting. Yeah, 45 minutes of questions. No question was, if I were in there, I would say, Chairman Powell, the last September meeting, the SEP have predicted that the neutral Fed funds rate is 2.9%, given the surprising strength of the economy, which you yourself admitted was surprisingly strong. Have you upped your estimate of what it is? What do you think it might be? Do you still think it's as low as 2.9 when we have this degree of restrictiveness? As I've said in the last 4 weeks to 6 weeks, I think the neutral Fed funds is 3.5 to 4. You could say 3 3/4. Now that's still 100 basis points under where we are today, but still, it's not that much. It's not that much under, and that it does mean the long rate goes up. So, all right. Now, as far as stocks are concerned, they obviously they like a Republican sweep and Trump. The only thing that would be bad about it would be, too much of a deficit. Now, let's go to tariffs. Tariffs he wants to use tariffs as a negotiating tool. This idea of 20% blank tariff, it brings in some revenue to fund some of the extra tax cuts that he wants, but not nearly enough. It invites retaliation, which is bad both ways. Trump is a man who prides himself on how well the Dow Jones average is doing. So not only will the bond market tell them, but the stock market will tell them if they really don't like the type of policies that he is initiating. That being said, there is a feeling in Congress, particularly the anti-Chinese feeling is strong. He talks about a 60% tariff on China. I think all of them are going to be selective as a negotiating tool, but they're going to be probably higher tariffs on China. And that still, makes for a story of the migration to India and other nearshoring areas such as Mexico there. What's going to happen with immigration? He talks about deporting 10 million people. I don't think that's going to happen. Registering them, and that's going to be fought legally also. What happened last time when there were so many legal fights. Wall never got built, never got funded, even with a Republican controlling both chambers of the Congress. So, but a wall might be, let's put it this way. The flow of immigrants, which is already slowing down dramatically, will really virtually stop. Only legal immigration basically will happen. But, you have how many millions and millions of people that are already here, and what's going to happen to them. I mean, don't forget, tariffs and immigration are two things that he can do a lot with without Congress stopping him or approval one way or the other. But again, he measures his success by the stock market, he's not going to do anything radical that is, going to upset the stock market. I'm still bullish, very bullish on the stocks. Again, we had a big move in Russell. I mean, this could spark a rally in the small caps. But you have to see them, you have to see those earnings go up. And of course, now with the Trump fiscal stimulus, that could argue that the neutral rate is even higher. I mean, if the neutral rate on Fed funds is high as 4%, which would mean our star X 2% inflation is 2%, which would be the highest it ever has been in the, 15 years that we've had dot plots since the Fed has started that. Not inconceivable, but, then the amount of reduction in short-term rate is going to be much more modest than we thought it was 6 months ago. That's not as good for small stocks. That's the headwind that we have for small stocks, but certainly onshoring, merger, accommodation, less regulation is all very, very positive in the stock space. We're supposed to end at 4:30. It's 4:17. I'm willing to take any commentary by Kevin, Jeremy, questions.
Professor, I wanted to just throw this out real fast, and we can put the tariffs to bed and move on. But, a lot of questions, not just that we got coming in, but just also, I know Jeremy, myself, people always talk about the inflationary impact of tariffs. Yeah. Can you walk us through that and walk us through what occurred during the first Trump administration?
Well, we did have selective tariffs that were brought on, and that did raise the price somewhat of those. But, I mean, when you take trade, what percent is it of GDP? And it's not going to be on everything. First of all, let me say the following. If tariffs go on with no retaliation, the dollar will strengthen. I mean, I think the dollar is going to be strong. I mean, both tariffs and fiscal deficits, which means the Fed's got to lean against it, going to raise real rates. That's strong dollar stuff. So the strength of the dollar will offset some of the inflation that those tariffs get put on. So there is going to be a bit of the tariffs. I don't know. I mean, how much? 1%, maybe, depending on what. First of all, he's going to exempt a number of things. Don't forget. I mean, he can't put tariffs on things we can't produce. I mean, I don't think he's going to put tariff on coffee beans. We don't grow coffee. At least I don't believe so. What would be the purpose of that? He wants to bring things back to the United States, made in the United States if it can be done efficiently. So there's a question of selectively putting those tariffs on. But yes, the dollar will go up to partly offset it. It will bring in some revenue, so it does allow some tax cuts that increases the income that would help the people. Well, the people pay taxes. I mean, we'll get more disposable income because he can fund some of his tax cuts, on tips and a few others by the tariffs. So that gives you a little extra income to offset the tariff increase in prices. But the answer is yes, it is inflationary, but not, it's only, take 20% on the 13% that we import, take the rise in the dollar, take the exemptions that there's going to be. How much are you adding to consumer price index? you know, maybe 1 percentage point over maybe the 4 years of his presidency. 2 percentage points, that's 50 basis points a year. I mean, if he goes 60 on China, I wouldn't want to own the dollar store as my equity. All that 60% of their merchandise is made in China. So there's a lot of things that are going on, and then of course we have wild cards. We have Elon Musk and the Efficiency Commission, and can we cut out some spending that reduces the deficit to fund the tax cuts that could offset any of the inflationary rise that tariffs can done. I mean, he's all going to do it, in his opinion, for the benefit of the economy, and the stock market will give the judgment about whether it is for the benefit of the economy or not, as well as the bond market. So he's going to have a real world disciplinarian, I should say, in the 10-year and the equities. You don't argue with those.
Well, the dollar is certainly something we've talked a lot about for people who want to follow up with us. We've got a lot of pieces on the role of currency hedging when you go overseas, international. A lot of people take the foreign currency risk. We talk a lot about the diversification of the dollar. So let's follow up with people. If you have any questions, come to us and we can talk a lot more about that in another forum. Professor, a lot of questions on, you talked about small caps doing well, the valuations, there was a question on the equity risk premium. So that could be an interesting idea for the people asking about what sectors, where do you like? Is there anything about small caps with respect to tariffs or anything that you'd say and on the valuation?
It depends so much on the small cap. I mean, if you're a dollar store, you're selling Chinese merchandise, you're in danger. If you're a small agricultural firm growing here in the United States, you're fine unless you're exporting it. Now, if you're exporting it, and the dollar gets stronger, I mean, actually, then that changes the price. That would raise the price to the foreigners as far as that's concerned. So there's a lot of caution on some of the agricultural items and whether they're going to be exempted or not in the tariff structure. I think it's generally, I mean, tariffs without retaliation will raise the price of the dollar. I don't think we know enough about what the tariffs are going to be on. A big tariff on China blanketly, then, anything that you could just go through every firm. How much do they import from China? How much do they sell into China? There's going to be retaliation from China if you put a 60%. So, if you're Starbucks selling into China or you have a big portion of your sales into China, I mean, Musk produces in China, sells in China, but, and then there's tariffs, on the Chinese EVs. I mean, it's really a complex animal here. Until we see how that falls out, it's really, being a macro person, that's not my forte. I mean, to actually go through and find out what he wants to put tariffs on, what his advisors and the political pressures from the various groups about what would happen. And then you always have to worry about that retaliation sector. I think he loves to use it as a one-to-one. He likes to go to the country, let this in, pay up your NATO dues. Because it's about it's the art of the deal. Let's make a deal. These are my chips. You think you have chips? Show me your chips, and let's make a deal. That's what I think he wants to do. And I myself have not gone through each industry or each firm to say, gee, what could be the gainers and the losers? No, that's just, it's not my forte to do that.
Now, Professor, you mentioned the yield curve, which I thought was great, the perspective on that. And, one of our high conviction ideas at WisdomTree, and given the fact that the curve is still inverted, say Fed funds or 3-month T-bills to the 10-year, and how Treasury floating rate notes still provide that income without the volatility. So I want to dovetail this with another question. You'd mentioned 4.5, maybe 4.5, 5 on the 10-year. And instead of getting all worked up as to how high you think it's going to go, let's take the other side of the trade. What would it take, or do you think it's even a reasonable scenario for the 10-year to go back to where it was at the last Fed meeting, which was, we got down to 3.6% on an intraday basis?
Oh, it would take terrible job data. I mean, a real fall off when we get the November data in the first week of December. And by the way, we did get, again, it was sort of interesting. Claims, again, the initial claims were right in that middle, the sweet spot, 200 to 240, right, 220. But those continuing claims hit a new, I think, a 3-year high. Again, just inching up and up and up. It's a little bit confusing. They are 1 week lagged, so we'll see what really happens. It's nothing that's alarming. We talked already about what that labor market report. I thought it was a weakish report, but not a disastrous report. What would it take for that to be there? If we start seeing claims, now that maybe the hurricane distortion is getting out of the data, if we start seeing claims marching again, 230, 240, 250, 260, and then we get to the November labor market report, and it's supposed to normalize and all the rest, and it turns out to be much weaker than expected. Because then you'll see the 10-year go down, absolutely, back towards 4% or above. But you will also see that would prompt an acceleration to a 50 basis point move by Powell. If he sees something like that happening, he's prepared to go 50. But that's what it would take to move the 10-year down into that region. There's no sign of it. And why would confidence, now that, Trump is elected and, that it's supposed to be, pro-business and all the rest, stock market is strong. What could cause that, fall off over the next 6 or 8 weeks? Obviously, what sort of geopolitical events happen, Israel, Gaza, particularly Iran, if it gets tough on Iran, with that embolden Israel to go and strike the oil there, which would bring about a spike in oil. Obviously, the oil market is not really expecting that. Oil went down because they think that he's going to encourage drilling, and that's going to oversupply oil to the market. I question a lot of what that is. They're going to take away restrictions. That's true. The oil companies certainly don't want an oversupply of that oil. But there weren't a lot of restrictions that were put back in place by Biden on oil production. It was really the price that fell so far during the pandemic that really shut the rigs. And many of them have come back as oil moved back to the 60, 70 region. But again, geopolitical events will influence oil.
I guess a very positive message on the taxes, positive on corporate sentiment there. anything that keeps you, besides this geopolitical risk that you just talked about, is there any other things that keeps you up at night?
I'll tell you what always keeps me. I mean, I always say that I worry about a cyber attack, a much more serious one that might affect major financial institutions or even get into the government. I think we have to consider cybersecurity right with national defense and our air defense and all our others. We have to make sure. And then, of course, there's always that grid problem of grids going down, especially with the greater need. But that, the worst thing that could happen is people wake up, can't access their brokerage or bank accounts. Someone has found their way into some critical financial system. Now, I don't think that's likely, but you're talking about, black swan type of risks. We have to put resources in to prevent that from happening.
That definitely is a topic we'll do more with. We actually work with a very unique organization called Team 8, who were led by the former leaders of Israel's cybersecurity unit, which is called the Unit 8200. And so we have a partnership with them. We do a lot of work on that. And so that seems like a good in-depth topic. We can do some more for people to talk about what's happening in cyber work. Professor, always great to get your insights on what's happening. Thanks for taking time with us. Kevin, always great to be with you.
Yeah.
Thanks, Jar.
Okay, guys, have a good day now.
Take care, everyone.